This opening slide frames Equinox Gold as a company that has materially changed its profile. The key point is the strategic shift away from a scattered multi-asset growth model toward a more focused North America-centered producer. The story now revolves around two cornerstone Canadian mines, Greenstone and Valentine, supported by a cleaner balance sheet and stronger free cash flow potential. That is why the investment perspective has changed. The company is no longer judged mainly on acquisition-driven growth. It is now judged on whether it can convert this portfolio reset into consistent operating delivery, stronger margins, and a credible re-rating. This slide explains today's Equinox Gold. Management now presents the company as an aspirational top-quartile producer, but the current value is built around four core pillars. First, the asset anchors are Greenstone, Valentine, Mesquite, and the Nicaragua Complex. Second, there is longer-dated optionality from Castle Mountain and Los Filos. Third, the Calibre merger and Brazil asset sale have fundamentally reshaped the company. Fourth, management is emphasizing free cash flow, debt reduction, and disciplined organic growth rather than portfolio sprawl. That combination is what makes the stock interesting today. Better asset quality, clearer jurisdiction focus, and a structure that is far easier for the market to value. Management calls 2025 transformational, and the metrics support that view. Equinox produced 922,827 ounces of gold, generated $2.71 billion in revenue, and delivered $1.34 billion in adjusted EBITDA. Just as important, the company reduced debt by more than $1.1 billion since Q2 2025. Those are large senior producer-style numbers, not junior or mid-tier numbers. The significance is not just scale. The company also completed a strategic repositioning that left it with a cleaner financial profile and more flexibility. That is why 2025 matters so much. It was not just a strong reporting year. It was the year Equinox reset its structure and gave the market a new framework for valuing the company. This slide focuses on the balance sheet improvement, which is one of the strongest parts of the Equinox thesis. After the Brazil sale, the company ended 2025 with about $430 million in cash, and by early 2026, net debt had fallen to roughly $75 million. That is a dramatic improvement from the more leveraged profile investors were worried about before. The company has also begun its inaugural quarterly dividend at $0.015 per share and added an active buyback program. Strategically, that means Equinox now has much more flexibility to self-fund growth, reduce residual debt, and return capital. For a gold producer, this shift from financial repair to optional shareholder returns is a major signal that the company believes the transformation is real. This is the operational heart of the story. Greenstone produced 223,843 ounces in 2025, with a strong Q4 ramp-up to 72,091 ounces. Mill throughput averaged 23,859 tons per day, and the plant achieved nameplate 27,000 TPD for 30 consecutive days in December. Valentine poured first gold in September 2025, achieved commercial production in November 2025, and produced 23,816 ounces in 2025. It was already running at about 90% of nameplate throughput in Q4, with full capacity expected by Q2 2026. These two mines are critical because they drive the quality upgrade in Equinox's portfolio. If they perform consistently, the valuation case strengthens materially. If they disappoint, the re-rating case weakens just as fast. This slide clarifies 2026 guidance and why the headline production decline should not be misread. The company guided to 700,000 to 800,000 ounces of gold production in 2026, with AISC of $1,775 to $1,875 per ounce. Yes, that is lower than 2025 production, but the reason is clear: the Brazil asset sale and the suspension at Los Filos. The strategic shift is toward better quality ounces and stronger margin potential, not simply higher total volume. Valentine is expected to be the lower-cost star. Greenstone should continue improving. Mesquite remains a mature, steady asset, and the Nicaragua Complex remains an important cash flow contributor. This is a portfolio quality story more than a volume story. This slide shows why Equinox is becoming easier to underwrite fundamentally. The company now has a total proven and probable reserve base of 19.1 million ounces. Around 70% of 2026 estimated production is tied to North America, and about 80% of consensus NAV is attributed to North American assets. The three core mines that contribute roughly 70% of production have an average mine life of around 13 years. That is important because reserve depth and jurisdiction quality matter a great deal in mining valuation. The market usually rewards longer life, lower risk jurisdictions more consistently than short life or politically difficult assets. This reserve and mine life profile is part of what makes the mispriced argument more credible. This slide highlights the organic growth pipeline, which management frames as more than 500,000 ounces per year of combined potential. Valentine Phase 2 is the most credible near-term expansion at roughly 225,000 ounces per year, supported by active expansion studies and existing infrastructure. Castle Mountain Phase 2 adds another 220,000 ounces per year, but confidence is lower because permitting remains the key bottleneck. Los Filos expansion has the largest single potential at 280,000 ounces per year, but it is clearly the highest risk optionality because it depends on community agreements, social license, and the resolution of operational suspension. Investors should separate core value from optionality here. Valentine is the credible near-term growth lever. Castle Mountain and Los Filos are upside, but less certain. This is the valuation slide, and it is central to the mispriced argument. On analyst consensus, Equinox trades at about 0.98 XP/NAV, with an average EV per ounce of production of around $16,930 based on 2026 to 2028 output. The company also points to roughly $1 billion in average annual free cash flow over that same period. External analyst sentiment appears generally positive, ranging from moderate buy to strong buy. The core message is that the market sees room for a re-rating toward top quartile peers, but only if execution improves. In other words, the valuation is not deeply broken, it is conditional. The upside exists, but it depends heavily on Greenstone and Valentine delivering steady production and meeting operational targets. This slide explains why some investors still hesitate. First, Greenstone missed early expectations, so the market wants proof of execution, not just guidance. Second, AISC is improving, but the consolidated company is not yet seen as truly best-in-class on cost discipline. Third, Valentine looks promising, but it still needs to demonstrate steady-state production. Fourth, Los Filos remains uncertain, limiting value realization from that part of the portfolio. Fifth, the share count remains large, which makes per-share re-rating harder. Finally, Equinox remains highly sensitive to gold prices, so while the company is clearly improved, the stock still carries a show-me element. That is exactly why the valuation can still look attractive. This slide reminds us that Equinox is still a gold equity first and foremost. In 2025, the company realized an average gold price of $3,465 per ounce, which provided strong margin support. If gold remains strong in 2026, the company has 4 clear opportunities: eliminate remaining net debt, self-fund organic growth, support dividends and buybacks, and improve valuation through multiple expansion. If gold weakens, the story becomes much more execution-dependent, especially for higher-cost parts of the portfolio. That is the key point. Equinox is structurally better positioned today, but it still lives in a gold price-driven market. Gold strength helps the transformation look smooth. Gold weakness would test whether the operating improvements are truly durable. This slide summarizes what management and the market appear to expect next. Management's operating target is clear. Greenstone and Valentine should be at full capacity by around mid-2026. Financially, management is aiming for net debt elimination in 2026 and has already begun capital returns through dividends and buybacks. Analysts appear to expect stronger per-share cash flow, a cleaner valuation after the portfolio changes, and room for a re-rating if execution stabilizes. The market consensus is supportive, but cautious. Investors recognize that the company's structure is much better, but they still want proof that this version of Equinox can consistently deliver. So the expectation is positive, but still conditional on operational follow-through. The bull versus bear framework here is straightforward. In the bull case, Greenstone keeps improving, Valentine ramps smoothly, net debt reaches zero, and higher return expansions like Valentine Phase 2 support a meaningful valuation re-rating. In the bear case, Greenstone underperforms, Valentine ramps more slowly, Los Filos remains problematic, and higher operating costs combine with weaker gold prices to keep the stock in a show-me category. This is an important slide because it highlights how operational delivery, not just gold price, will likely determine the next phase of the stock. The upside is real, but so is the risk that the market continues to wait for harder proof. The conclusion is balanced but constructive. Equinox has successfully pivoted into a North America-focused gold producer with real scale, 2 cornerstone Canadian assets, a much stronger balance sheet, and visible free cash flow. That is a clear improvement from the old structure. However, management itself is effectively acknowledging that this is still an incomplete transformation. The valuation case depends on proving consistent performance at flagship mines. That is why the next few quarters matter so much. For investors who want leverage to gold with improving fundamentals and a cleaner asset base, Equinox looks attractive. For conservative investors, the company still needs to prove that the transformation can convert into repeatable operating success.